you one of the many entrepreneurs who've fallen for the hype around bonus depreciation, Section 179, and writing off your vehicle? Maybe you've even heard of YouTubers claiming you can get a tax-free Tesla. But the truth is, it's easy to let the tax tail wag the dog. In this video, I'm going to reveal the reality behind these tax strategies and show you why you may not be saving any money in taxes at all. In fact, you could be paying even more than you'll ever save. So if you're ready to uncover the truth about bonus depreciation and avoid falling for these sort of false promises, then stay tuned because this video is going to change the way you think about vehicle tax deductions. All right. So let me explain what I've got going on here on my screen so that you can fully understand. I wanted to use very reasonable numbers when I did this analysis. What we're looking at here is a scenario where we have a single taxpayer who earned a profit of $175,000 in their business. In this particular example, the business is taxed as an S corporation. And so the $175,000 is allocated between reasonable compensation, which I'm saying is $65,000, and the remaining amount, the $110,000, will likely be taken out of the business as a distribution, which I'm referring to here as a K1 because that is the tax form it usually appears on. If I already lost you, don't sweat it, okay? The fact that this business is an S corporation doesn't matter that much. Just follow along with me here and we'll go through this together, okay? What I've done here is kind of gone through the examples of what would happen if, that was the profit I had in my business and I didn't buy a vehicle at all. Then I'm gonna compare that with buying a reasonably priced vehicle and then buying more of like a luxury type of vehicle, okay? So in my examples, I'm choosing the Toyota RAV4. And I don't know if you're aware of this, but apparently that was like the top selling SUV in 2022 with I believe like 400,000 units sold or close to it. And so that's why I picked that vehicle. It really doesn't matter what vehicle you choose. And then I chose like sort of the comparable like luxury model up from that, which would be the Lexus GX. At a price of like 70 grand. But let me take you through the math and so you can kind of understand what's going on here, okay? So with no vehicle purchase at all, then what's happening here is the adjusted gross income is $175,000. That's a tax term. Don't worry about it too much if you don't understand what that is. The standard deduction, we're just using a single taxpayer here. So the standard deduction is $12,950. The QBID, qualified business income deduction, is a percentage of the K1. So that's where this number is being derived from. And so your taxable income, you take the 175 and you minus the standard deduction and QBI deduction, and you get $140,050 as your taxable income. So how much do you have to pay in taxes if that's your taxable income? Well, it's $27,448. Okay, that's sort of the base case if you don't buy a vehicle and you have that much profit in your business. Now let's look at the next column is I'm saying you bought a reasonably priced car at $35,000. So in this case, the business profit obviously gets reduced, right? Because you were able to take a deduction for the vehicle in the first year. In this case, it's $19,200. Okay, so that's why this amount is reduced by about $19,200. So your W-2 amount, your reasonable compensation that you paid yourself is $65,000. I'll come to this later on why I didn't reduce that number. And then the K1 is $90,800, okay? So the AGI is reduced, $155,800. Still get the same standard deduction. The qualified business income deduction is reduced because it's a percentage of this number. So now that's $18,160. And so your taxable income is reduced down to $124,690. The amount you now owe is $23,761. So your tax savings is just the difference between these two numbers, right? $3,687. And not only that, but you are still able to use some of these, tax strategies, if you want to call them that, Section 179, whatever, in year two. So you now have sort of like a ace in your pocket, if you will, of $15,800 that you can use in year two to use as a tax deduction. All right. Next up, we have the Lexus GX, which I priced it at $70,000, which is like the base price, I think. But anyway, your business profit, because you're writing off the full 70 grand, right? 175 is before writing off anything. You wrote off the whole thing by using bonus depreciation, is $105,000. Your W-2 is $65,000. Your K1 is $40,000. What does this do for the other numbers? Well, your adjusted gross income is reduced dramatically, right? By 70 grand. from the base case. So 105,000, your standard deduction is the same. You do get a reduced qualified business income deduction, right? So it's way down to $8,000 at this point. And your taxable income is now only $84,050. So what's the amount you owe in taxes now? Well, it's $14,114. So your tax savings is $13,314. If you're wondering what the math is on that, it's just the difference between this and this number here. So $13,334. And again, your year one tax deduction is $70,000. Now let's look at some of these numbers down here that I have for you. I think this is where you'll really kind of put the puzzle together here and make sense of all of this. The cost of the vehicle was $35,000, right? That's what we have here in this cell here. Your taxes owed was $23,761. So your total cash outflow is $58,761, right? It's the cost of the vehicle plus the amount of taxes that you owe. You have to dish out $58,761 to get into this scenario, okay? Let's look at the other scenario here of the Lexus. Well, now you paid $75,000 for the vehicle and you owe $14,114. So you greatly reduce the amount of tax you have to pay. But your total cash outflow has increased to $89,114. So although you saved $9,647, your cash outflow difference is $30,353. So you spent an additional $30,000 to sort of save $9,647 in taxes. So it doesn't make much sense. Let me, in a moment here, kind of go over the considerations that I've written. It's important that you kind of understand all of the different variables that go into this because it's much more than just the analysis I just did for you. But before I do so, allow me to take a quick break to introduce myself for those of you who are new to my channel. My name is Navi Miraj. I'm a certified public accountant who specializes in helping entrepreneurs like you save thousands of dollars in taxes. And I do that by providing free and valuable content here on social media, but I also developed a comprehensive course that transforms you from being a sort of tax novice to a savvy entrepreneur who knows how to implement tax strategies that will save you thousands of dollars in taxes. And I do it in an easy to understand way that anyone can apply. Also, if you visit my website, which is navimuradcpa.com, you'll find free resources that will help you navigate the confusing world of taxes. Links to both the course and my website are listed in the description below, depending on which social media platform you may be watching this on. So let's look at these considerations I've listed here. So the first one is you're probably not really using the 100% or the vehicle 100% for business, right? If so, do you also have a separate vehicle for personal use? Because, if you get audited for this, how are you going to tell the IRS auditor that, this is your 100% used vehicle if you don't have another vehicle that you can use personally? Unless you're going to tell them, oh, yeah, for everything personal, I'm very strict about it. I just kind of Uber around town, all right? So the second one here is, I mentioned it earlier, you spent $35,000 more for a vehicle that's sort of qualified to be, 6,000 pound plus to save $9,647 in taxes. Does that make sense to you? It really doesn't to me. Now, the argument that could be made is, what about the time value of money, Navi? I now have $10,000 in my pocket that I can invest and, it will compound and what have you, and I'll earn more money. Well, I don't think you can do that, right? How can you take the $10,000 in tax savings and grow it into $35,000 in that short a period of time? Because you're going to need to grow it that quickly in order to just break even on your decision making here. In year two, and I mentioned this earlier, in year two, you have a $0 in depreciation. But if you purchased a reasonable vehicle, you still sort of got $15,800 deduction in your back pocket than you could use. And maybe it's more strategic for you to use it in year two versus year one. The next item is you should have reduced your W-2 amount, that reasonable compensation I mentioned earlier. You should have reduced it to reflect your business profit, but you probably weren't thinking about that because not to give a knock on them, I myself produce content on social media, but if you're getting your advice from someone who's like not a tax professional and doesn't do this analysis for you, then you might just not know any better and just pay yourself the $65,000, even though the profit in your business was greatly reduced, and you probably could have gotten away with taking a way lower reasonable comp. The next item here is you may have created a basis issue. Now, this is a tax concept that you might not understand, this issue of basis. So But what would happen here is you might actually pay long-term capital gains tax on any distributions that you took out of the business that were in excess of your basis. I had a client do this last year. They didn't consult with me. It's like Christmas Eve. They buy $100,000, literally $100,000 vehicle, okay? Well, we didn't plan for this, right? And so the client already took all the money out of the business throughout the year, and then they went ahead and bought this vehicle. Well, now they just created a taxable event for them, a distribution in excess of their basis. If you don't quite understand that, I have another video on my YouTube channel that will explain that. I really recommend that you watch it so you can understand the issue that's happening here. The next item is many states do not conform to the federal business depreciation tax laws. So if you're in California, good luck. You're going to pay the California income tax, okay? And it's not just California. There are many other states that don't conform to the federal bonus depreciation tax laws. And so you'll get a much reduced tax deduction at the state level. And the last comment here is just that there are many other factors. If you think I missed something, let me know in the comments below. I'd be happy to hear what your opinion is and what you've got. Or if you got questions about this, let me know this in the comments below. But in closing, let me share with you the conversation I would have with a client who tells me they want to purchase a new vehicle. It goes something like this. Hey Navi, I want to purchase a new vehicle for my business and write it off this year to avoid a large tax bill. Okay, do you need a new vehicle? No, my old one works just fine. Okay, well then you shouldn't buy it. That's kind of like step one. If they say, yes, I need one. My old one is 10 plus years old and it's having a lot of issues. Okay, cool, I understand that. Let me ask you, if you weren't going to get a tax deduction for purchasing this vehicle, which vehicle would you be purchasing? Oh, well, I'd probably, I like the new Mazda SUVs. Okay, cool. Well, buy that one and maximize the deductions we can get with that more conservative, reasonable vehicle. Did I save the client $10,000 in taxes? No, I didn't. Instead, I saved them $35,000 in money they didn't need to spend, and their new car payment isn't $1,200 a month for the next 6 years. So listen, be smart. Don't let the tax tail wag the dog, as they say. And I hope, in closing, I hope to see you either in the course or in the next video.